Would a Rolex be tax deductible?
The Rolex would need to be owned by the company and you wouldn't be able to take it home.
Can I write off a G-Wagon?
The G-Wagon depreciation, as long as it's the 6.3 litre, you can only write off the depreciation component up to.
How can business owners pay less in tax legally?
Structures is a really important avenue for saving tax. Who owns the structure can potentially save you tens of thousands of dollars in tax each year, but most importantly, when you decide to exit or merge or acquire, you can be saving hundreds of thousands of dollars on the exit of a business if your structure is right.
Welcome to Founders Playbook podcast, the ultimate guide for entrepreneurs to build their empires, increase profits, and become great leaders. I'm your host, Nelson, founder and CEO of Vibes Creative, Australia's leading video podcast agency. Let's get down to business. Welcome back to another episode of Founders Playbook. Today's guest is an elite business advisor and fellow certified practicing accountant, which basically just means he has the highest pedigree when it comes to accounting. He's also the managing director of Rees Group, and full discretion, they are my accountants, okay? And we're very lucky to have him here today. He is Justin Mastores. Welcome to the podcast.
Thank you. Thanks, Nelson.
Justin, what do most business owners get wrong about taxes?
Okay, big question. Lots of different answers. We can go down that way. So what I'd like to focus on first is, I've mentioned before that sometimes when people start out, they give it a go, and when it comes to tax, they go, I'm going to do this myself, or I'll check out my gov and I'll work out what I can deduct or I can't deduct. I think what they get wrong is once you've passed the infancy stage, you need to actually grow up a little bit and actually take some advice, okay? So some of that advice is online. Some of the advice is sometimes talking to people in your industry. Sometimes it's talking to an accountant, but actually listening to the right advice about your business, your particular industry, and what you can and can't claim for your business is really important. I think that's number one. Number two, I think also too, when people start out and as they go along the way and they start earning some more money, sometimes they get a little bit greedy with tax. So you mentioned before, like fellow CPA. All that means is I've been doing it a long time. But in the olden days, in the 2000s, the ATO didn't have the data matching that they have today. But now they've got a whole lot of sophisticated AI and other software. Apparently, a lot of the online questions you ask are answered by AI. There you go. That's all happened. But so where the ATO matches a whole lot of data. So mistakes that people make is they get a little bit greedy. They go, okay, well, I'm in this industry. I'm a tradesman doing this, but I'm actually going to claim all these extra deductions in my business. So getting a little greedy and not paying attention to your advisor or the person that's helping you with your tax, because the ATO, they also benchmark. So they benchmark a lot of data around industry, gross profit, net profit, and tax. So a lot of people don't know that, but yeah, it's happening a lot more nowadays.
When I first got started with business, that was one of the questions that someone asked me, like, oh, who's doing your tax returns? I was like, what do you mean? What do you mean? Do I have to do that? Right? Coming from, especially getting new to a country like Australia that had no clue how this would work. And I used the government assistance when I was completely broke at the beginning, right? And eventually transitioned to a point where obviously things got a little bit more complicated and started to make some money. And I took the advice of just a friend of mine, like, hey, you should go to my accountants. And I just realized, like, oh my God, I don't have to waste my time with this thing. There's people that can just take care of it. It's not as expensive as you would think as well when you're just getting started. That it essentially, there's not much complicated company structures. Correct. And all these things as a sole trader. And the other big mistake that I made when I was first getting started as well was not having an accounting software like Xero.
Wow.
That was horrible.
Yeah.
In fact, one of my friends was with me when I was trying to backtrack the tax returns of the last year. And I had to just go and manually put all those receipts, all those things. And it was such a waste of time that I was like, I should have just gotten the advice.
The software now and the add-ons to Xero. So, if you are in business and you've started out, you need to actually sit down and do some research, because there's so many add-ons to Xero, expense capturing, logbook capturing for your business travel and your vehicle. And what the software has done in the last probably 10 years, it's gone leaps and bounds. It's really exponentially improved, where, to be honest with you, if you're turning over $1 or $2 million a year in your business, you might need a little bit of assistance from a bookkeeper point of view. But generally speaking, the software is going to auto-reconcile and do a lot of that grunt work for you that you don't have to do yourself, and you don't have to pay someone to do as well. So that's a whole other little avenue we could go down with software. But definitely it's having the right advice, setting it up properly, setting up your software the right way, and using the right people. Like this morning, just as an example, we have a client that was growing into a different market. So you said, when you first came to start your business here and understanding the structures, this particular client's growing into the US. So what do? And we're advisors, but we're Australian advisors. We bring good people in from the US. So the call I was on this morning on Zoom was, hey, let's talk about structures and understand, because we need to pay the right people to get the right advice to do it the right way. Saves you so much time and effort in the future.
Absolutely, which ultimately you can't get that time back, right? You obviously deal with many different big businesses, right? What's the main difference that you see between 7 and 8 figure businesses when it comes to their tax strategies?
I used before the analogy, so going from starting out to then, progressing as a business. Maybe you've been going for 2 or 3 years, and you've progressed to a stage you might be turning over 6, moving into 7 figures potentially. I think it's the system and the rigor behind the scenes. So, if someone starts out, I'm just using this tradesman example. For example, they're an electrician and got a few contractors coming on board, and then they're turning over $1 million a year because they've got the subcontractors. All of a sudden, then to go to the next stage where they're doing $2 or $3 million of revenue and having a whole lot more input from people. It's the systems behind the scenes. So the way that they approve the spending of money internally, with the internal process, having the right finance person potentially internally to manage cash flow, manage your creditors and your payments, manage your, the debtors and the people that are paying you. So what I see and what I've seen in my experience is the businesses that do really well as they grow, then put on the right people or have the right skill sets within their business to make sure they have the rigor and process behind the scenes.
Got it.
The right platform to grow.
Got it. So systems is a big one and the people behind it.
Yep.
I want to get to the main question
Yep.
that everyone has right now.
Yep.
How can business owners pay less in tax legally?
Yeah. So we talked again before about starting up. I think taking the right advice up front, because structures is a really important avenue for saving tax. So sometimes when you start out in business, you start out as a sole trader, or you might just set up a company and you might just do that yourself. You might not have taken advice to do that. And you think, oh, well, I spoke to someone at my friend's drinks and that's what they said I should do. But getting the structure right initially, and who owns the structure, can potentially save you like tens of thousands of dollars in tax along the way each year, in the way that you pay tax from your business and you individually. But most importantly, and we'll talk about exits later, but when you decide to exit or merge or acquire, you can be saving like hundreds of thousands of dollars on the exit of a business if your structure is right. The day-to-day savings in business, the ATO, and I come back to this, and I'm a tax agent, so I'm regulating for the ATO on their behalf. They're pretty tight now in they've closed a lot of, not loopholes, but areas you could be potentially a little bit more aggressive in tax. I think they've basically said, now we understand your business, and I talked about benchmarking before. We expect a business turning over X to be claiming these sorts of expenses. But I think having the discussion about what you can and can't claim, like, business travel, traveling for work relating around conferences and education, looking at ways in which you can make your endeavors tax deductible because they're benefiting your business. That's a big one. So I think I mentioned to you, we have an office on the coast now. That's something we acquired, but it means that all of my travel here, yes, I get to be in a great office in a great part of the world in Queensland, but all my travel is tax deductible. So I think that's the thing, is asking the questions and workshopping with the person that's giving you advice about how to maximize what you're claiming and how you do it.
And just to be clear, with that one specifically, that is a very common one, right? Travel. In this particular case, every single expense that you do on that travel, gets to be tax deductible?
Okay. So if you're traveling for work, generally speaking, yes, there's some rules around alcohol and fringe benefits of alcohol. But if we talk about Justin coming to his office in Queensland, my accommodation, I've got meetings every day. So everything food and related, because I've got to eat while I'm here. Otherwise, I can't talk in the meetings. So everything is deductible. So again, workshopping the analysis of what you're going to be doing with someone is really important, because you might find you're actually missing out on quite a lot, and you might find that you're not actually thinking, oh, that's private, when it might not have been private. So that distinction between private and business. Especially if you're running through a company, a lot of people think, oh, that's private. Well, really, if you're running a business, your personal living costs, your personal food and care, and your family's costs, they're private. But a lot of what you do when it comes to travel and everything else should be deductible if you're structured properly.
Got it. So that's travel.
Yeah.
What are other common tax benefits that basically can help you pay less taxes, or other low-hanging fruits?
Low-hanging fruit. So obviously around IT equipment, vehicles and related. So depreciation, we get to write off the cost of new microphones, cameras, other bits and pieces. That's I often say to people, if you need to update things, before June's a good time to do that and spend the money, because generally speaking, up to about $20,000, you get a write-off for taxation. So you get depreciation, which is the diminishing value of that asset. You get to write it off really quickly. And again, vehicles, you got to assess how old your vehicle is, what you're spending versus how long have you had it, and is it written down in your business, or is it time to potentially change that over? But a really big one, and probably the lowest hanging of all fruit, is when a business starts to become successful, you start to earn a whole lot of money, and you're probably in your 30s and you're thinking, okay, well, like this whole superannuation thing in retirement so far away. I can tell you it comes really fast, or close to the retirement age. You sort of start looking, shit, I've only got 15 years left. Is superannuation. So the government allows really big windows and amounts of what are called deductible contributions, where you can put money from your business into super and get a full tax deduction for it in your business, and only pay 15% in your super fund. And then also to personal or non-concessional contributions into superannuation. So most people in their 20s and 30s aren't thinking about super, but if there's a takeaway from today, it'd be like, well, just sit back a little bit and look at superannuation, because most people think of superannuation as my Australian super account that I can't touch till I'm 65. Again, in talking to the right people and taking the right advice, superannuation is another bucket of investment on top of your house, on top of your investment properties, on top of your business. You can potentially use that superannuation through a self-managed environment to start, really getting it working for you. So if you're getting a tax deduction in your business by putting more money in super, and then you're able to use superannuation, is one of the ones that's most low-hanging.
I want to come back to the superannuation, but I want to close the loop on something that might be quite crucial, which is depreciation.
Yes.
Can you explain exactly how does it work when it comes to equipment, computers, but also car depreciation? Because I think there's some differences in there, right?
Yeah, correct. Okay, so let's talk about computer depreciation. So everyone's got computers and IT in their business. Generally speaking, something you could buy, so your new iMac that's, I don't know, $4,500. Generally speaking, the effective life and the rules of writing that off means you can write that off in the first year. You can basically say, I've bought that, I get that as a tax deduction that first year because I use it in my business. Larger items of equipment. So we'll come back to cars in a sec, but if I'm a farmer and I've got a tractor as an example, but the tractor's cost me $250,000, I get to write off an amount of depreciation or tax deduction every year based on the useful life of that tractor. So if it's only 5 years and it cost me $250,000, 20% of that each year, I get to write off as a tax deduction. So that's for non-cars, non-vehicles. Let's talk about cars. The ATO says, well, if you buy I have a hire car today, it's a Cupra. So the Cupra is electric, it's fantastic. It only costs you $55,000. The ATO has a depreciation cost limit, which is about $59,000, $60,000 a year. $58,000 is up to that level. You can claim depreciation over the effective life of the vehicle. So let's say it's $60,000. I can claim that over 4 years, I get to write that car off to zero value, and I get that deduction over time. Through COVID, they had some rules that meant we could write it off really aggressively. That's all gone now. But if you like Bentleys and you've bought yourself a secondhand Bentley and it's cost you $250,000, they have what's called a depreciation cost limit. And they say, hey, for cars, we know you need a car for work, but let's not get too aggressive here. You can only tax deductibly take up to that $58,000, $59,000 of depreciation. And the rest, sorry, you can't actually write that off for tax. Is that clear?
So can I write off a G-Wagon?
A G-Wagon. Yeah, you can write off the running cost of a G-Wagon, and you can run off, so all your business travel, but your depreciation, the G-Wagon depreciation, as long as it's the 6.3 litre and not a G-Wagon with the 4.3, I think it is, you can only write off the depreciation component up to that $59,000.
When it comes to luxury vehicles as well, what are the tax implications of purchasing a luxury vehicle?
So the big
what does even entails luxury?
Yeah, okay. So the luxury is basically they say it's over that $59,000. The big one right now is EVs. So EVs, there's a huge benefit around fringe benefits. So you don't pay any additional tax for personal use of the vehicle. So EVs, like the Cupra I'm in today, is fringe benefits tax-free. So you don't actually pay any fringe benefits tax. So there's a big push toward EVs, and the government want us to drive them. So whilst you don't have, obviously, petrol costs and other related, you get to write off the cost of the EV with no other ancillary tax fringe benefits implications. So that's a big one. So that luxury vehicles, what I often say to clients, so if you've done really well in a few years and you've gone, your year 4 or 5, your business, you've gone from turning over hundreds of thousands to millions of dollars. What I often say to clients is there's some better strategies around, because the ATO is cracking down on this, and they cross-check how many vehicles you have in companies and things like that, depending upon the size of your business. So what I often say to people is make the money, pay the tax, and take the advice to maybe take some dividends and go buy the brand new G-Wagon in your personal name potentially, because then you don't have tax implications of that moving forward. But make sure that you've got a good work vehicle that you can write off. But the ultra luxury vehicles, sometimes there's some simpler ways to do that, and take the money from the business, pay the tax, and then have that outside of the company potentially.
Got it. So I will be able to get the G-Wagon and still get some benefits.
As long as it's black.
Yes, we're getting 100% the black matte. That's the one that we're getting.
Fantastic.
And just to confirm, okay, so we have some, depending on the particular item or vehicle, there's different ways in which that depreciation will work and percentages, as well as across a specific amount of time. When it comes to something like, let's say, like the computers or iPhones or anything like that, you get the full amount depreciated, or is still a percentage?
Good question. So business related, up to 20 grand, go hard. Just to get you write it off basically. So if you need, we're now in end of March, almost April. You got a few months to decide if you need to spend money. You got to have the money to spend the money to write it off. But you get to up to 20,000. Essentially, write those amounts off. Okay, but vehicles, take the advice on if you did want to spend more than $60,000 on a vehicle. Take the advice on the best way to structure that. Whether you're borrowing money to buy it, whether you're actually paying cash for it, and then how we're writing that off in the books for the company as well.
Got it. And just to confirm, those $20,000 is across all those items.
Yeah, well, it's actually each item up to 20,000, believe it or not.
Okay, so each item.
Yeah, so you can buy that new camera that costs you 16,000. You can write that camera off. You can choose as well. Like someone might not be having a really good year for profitability this year, so they say, I'm actually not going to write it off this year. I'm going to write it off for the next 2 years, so I can get a bit of the depreciation next year as well. But again, that's a discussion you can have with your accountant and working out the best structure.
Going back to superannuation. Now, here's how I think about superannuation.
Yeah.
Saving tax with that sounds awesome. However, I want to make millions now. I don't want to access my money when I'm 60 something. I want millions now and I want to use them today. I don't want to wait for it. In my mind, it's undeniable that I will have plenty of millions by the time I get there. I don't want to kind of tie up that money in a way that I can't use it and I have to wait until I'm 60.
So I'm a little bit like you as well. Yeah. So the problem with superannuation, and I know, people in government positions will listen to this podcast, is the ATO, the Australian Taxation Office, cannot help but keep touching superannuation. They keep changing the rules. So I'm not a financial advisor. This is not financial advice, but you need to be very careful, and I talked about a good strategy before, but the ATO love touching super. They love touching the way you can take it out. They like touching the tax rates and changing that with superannuation. They brought one in a few years ago based around ultra high net worth individuals that had a lot of money in super, and they said, oh, well, actually, because you've got so much in super and you're self-funded, anything over 1.6 million that Nelson has in his super fund, we're going to tax that differently now, and that's not going to be tax-free when you retire. So unfortunately, I can pretty much guarantee you sometime in the next 10 years, they're going to change superannuation again. So you've got to take that and think back to yours and my philosophy a little bit, and say, well, how much money do I actually want to put into superannuation, given I need that balance between having it outside of super and inside of super. So the way I look at super is, I talked about buckets before. So, you've got your personal investments with your partner, you've got your business investment, you might have some other investments in a family trust, some other, property, crypto, whatever it might be. Super's another investment bucket. So I think when we're having a robust conversation around, how do I potentially minimize tax, but then also to invest in the super, you've got to look at it depending upon all your other buckets as well. And I would never say to someone, hey, Nelson, don't buy the G-Wagon, put all that money into super, because you're right. You're not touching it for 30 years. And in the next 30 years, they're going to change the rules around superannuation. The thing about super that the listeners need to understand, super is more tax effective within super than outside of super. So what I mean by that is a lot of the listeners today are paying top marginal rate, just under 50% with Medicare levy. Super, you only pay 15% tax, right? So there comes a point where you say, well, I've had a really good year. I've made $500,000 this year. You know what? If I put 20 grand of that into super and I save myself thousands, that could be worthwhile. And I think it just comes back to assessing each year and how you go and how much goes into super is really important. Super also is a great asset. We see it with clients as well. It's a bit of set and forget, and it does help you later on. By that I mean, in your 30s, I'm not saying necessarily you need to go as hard as putting everything you have into superannuation under every opportunity for deductible and non-deductible contributions. But by putting a little bit of extra into superannuation, the compounding effect of that investment, of that superannuation, may mean that you have hundreds of thousands more later on. And super, the way I look at it, the government wants you to self-fund your retirement. So they let you take basically index that's like $1.8 million out over time to fund your lifestyle when you're retired over 65. Now, the problem is most people are living much longer than 65, right? So that money might not be enough. And B, you've got to balance it out with your investment trusts and the other investments that you've got and money that's outside of super. So I think I've answered the question.
You did.
Okay.
Now, the other part that I look at when it comes to super is like, well, I don't trust anyone when it comes to my money. I trust in terms of getting it to work for me. Yep. So I'll be looking at a self-managed super fund.
Yep.
Who should be looking at a self-managed super fund, and how do you know is the right time for it, because it has some implications?
Yeah, absolutely. So a self-managed super fund is a legal super fund that is essentially operated by trustees. In your case, if you were to set one up, it's yourself and your partner, and you're managing your own money. Now, some people who have a self-managed super fund then get someone else to advise on, where the money goes. But the reality is, a lot of people that set up self-managed super funds, they take advice to do so because they want to do something that's not vanilla. So it's legal, but it's not Australian super mixed equities medium growth fund, right? They go, actually, I've noticed there's a growth corridor, at the back of the Gold Coast. I want to buy a house that's, already there, or 2 units, and I want to do that in my super fund because I've already got money in my super fund. And you have to roll your money out of where it currently is. I've used this example of Australian super. Take the advice to put it into a self-managed super fund, and then you take control of your money and you invest it for yourself. So I have a self-managed super fund as an example. Why? Because I want to manage my own money. I don't want others to be managing it. And there are some rules with self-managed super funds that are quite cool, is that you can buy up to 5% of the value of the fund in collectibles. So they can be potentially collectible watches, they can be collectible artwork, collectible cars, things like that, because those things do go up in value if you buy well as well. So all of a sudden the listener's going, hey, I didn't realize I could do that. Well, again, talking to the right people to take the right advice. If you're a super conservative person and you like your Australian super, great. But if you want to talk to someone about the options, about other things that you can have in super, and the great thing is about partners as well, they can bring their superannuation together in the one self-managed super fund. So all of a sudden you might have 100,000 here and 100,000 here, bring it together, you got 200,000. You ask the question, when's the right time to have a self-managed super fund? Obviously, there's all very general advice for everyone, but you need to take the right financial advice. But ASIC, Australian Securities Investment Commission, released something a few years ago saying, generally speaking, you should have $200,000 to $250,000 in your super to make it worthwhile, because you've got to pay fees to manage your self-managed super fund, just like you pay fees with your Australian super. But generally, around that 200 to 250,000 is a good time to be looking at a self-managed super fund. One more thing. Self-managed super funds, as opposed to your Australian super funds, they can borrow money for property. So some people like to, using that property example before, say, well, I've got $500,000 in my super fund. I'm actually going to borrow with Liberty Financial or one of the financial institutions. The big banks don't lend on super as much as they used to anymore. So it's generally a second-tier financier like bank. You can actually borrow money to buy property, but you can't live in it yourself. It's got to be an arm's length. It can be commercial, can be residential. But so there are hundreds of thousands of Australians using their super to buy property around the country. And I think that's a really good strategy if it's balanced with your overall investments.
Got it. In terms as well of that money that is suggested between the 200 to 250,000, that doesn't mean, though, that someone needs to have that. That's the recommendation.
It's a recommendation. So sometimes, I've seen before where someone has a lot less than that, but they know they want to buy a certain type of asset. They want to trade crypto. So you're allowed to trade crypto in your super fund, but you're taking responsibility for your own retirement, which I like. So they might only have 50 grand in the self-managed super fund, but they know with the investment strategy that they have that they've been doing outside of super, they can double that money in 2 years. So in that particular case, if you're going to back yourself, knowing that it's going to cost you $2.5 grand a year to run your super fund, go for it. But take the advice, speak to a financial planner about that and whether or not it's the right thing for you. But again, that ASIC guideline was just a watermark that they gave, because you have to understand a lot of people are not very educated when it comes to superannuation, so they needed a guideline to give to people. But as I said, I've seen situations where people have a lot less than that, but they've been super active and very successful in how they've managed their own money.
Yeah, exactly. So essentially it comes down to if you understand the particular asset that you look into, and let's just say that you're not at that benchmark of the 200,000 plus, but you believe that your money is better placed on this asset, and you're okay with the fees that will be implicated in this process, you still can go ahead and have your self-managed.
Absolutely. Yeah. Talk to your accountant, talk to your financial planner, and then just talk through the process of setting it up. There's rules around it, but you just if you're going to take your retirement to your own hands, which I'd probably recommend most people should do if they've got some time, but take the advice to set it up properly.
Now, we spoke about luxury cars. We haven't spoke about luxury items.
Yes.
I love watches.
Yep.
Rolexes.
Yeah.
Is a Rolex tax deductible?
Is a Rolex tax deductible? I'm pretty sure you've asked me this question before. So generally speaking, a Rolex is not tax deductible. But if you're in a profession where you needed to have a certain watch for a reason, or you needed it on photo shoots or something like that, well, potentially it could be. But generally speaking, luxury items, unless you're in a luxury branded type business, are not deductible. So, you can't go out and buy the latest, Fendi handbag and put that through the business. Because what that exposes everyone to, if they're in business, is it's called fringe benefits tax, where you're essentially got a benefit from an item that's owned by your business or your company. Okay, so we're just got to be careful with that with watches. So again, watches or luxury items are a little bit like the luxury, like super luxury car. Sometimes it's best to structure your business properly and minimize your tax that way, so you can pull the money out, and then potentially, if you're going to start a watch collection, be buying those outside of super. For me, it's Omegas. So it's, some vintage Omegas, some not so vintage Omegas. But again, I've done them in my own name outside of the business.
In your own name outside.
Yep.
Is that, as you said, under the self-managed super fund 5% collectibles, or literally?
No, so I know of people that do that under 5% collectibles. You can do that. But no, for me, it's just been, sharing some information just personally. But much easier to do it that way, and then obviously from an ATO point of view, you're not flagging anything.
But that means that you're not really getting any tax benefits.
Not really, no.
That. You're just paying for the thing in
Correct.
full. Hypothetically,
yes,
if I was running an agency business that consistently makes content, ads, podcasts, and is targeted as well towards their customer that is high-level business owners, entrepreneurs, would a Rolex in that particular position, where it is used for content, it is used as well for advertisement that clearly attracts that particular dream customer, as well as the meetings and everything related to this type of market, would that be a place where the Rolex could be tax deductible?
Yeah, potentially, but the Rolex, the asset, would need to be owned by the company, and you wouldn't be able to take it home. Mm-hmm. So you use it for work purposes, and then essentially lock it away and leave it, in a safe place. But again, if you wanted to use it personally and wear it on weekends, you couldn't have it in the company. So, but again, you'd need to have a chat, talk about the best structure and who you're going to use it for, how much content it's going to be in, all that sort of thing.
Got it. That's why I never take my Rolex home as well. Like, it always stays within the business
Fantastic.
Premises and content.
Good to hear.
In itself. Can you avoid paying taxes completely, legally?
In Australia, no. So again, I'm a tax agent. The way the ATO in the last 20 years, what they've done is there were never loopholes, but there was ways in which you could be a lot more aggressive, and the ATO knows about this. They've released a lot of statements, and they've slowly over time just squeezed and then brought it back to go, here's our tax compliance system, and to build roads and hospitals, we need everyone to pay this amount. And we need you to work in these parameters. So, if you're making money, you got to pay tax, but you can minimize how much tax you pay by structuring yourself correctly and making sure that if you've got investments, you've got an investment trust. If you're running a business, you're not necessarily running as a sole trader. You've got the right structures in place, because the way the money moves between structures is really important, and the way that you invest from the profits of your business is important as well. So it's still possible to minimize tax, and there's a whole industry around legally minimizing taxation, but you've got to take the right advice, but you can't get away with not paying tax. You just got to pay tax,
And just to confirm, because this is something that I've seen as well quite commonly especially in the property investment side of things, could you not pay taxes at all deploying all your capital, earnings, and money towards, let's say, property investing.
Property. So I've seen like on Insta and stuff, there's a lot of ads around this, don't pay tax by investing in property. I just want to warn people about that because it's called debt recycling, where you're basically running two pots, putting all your income into one pot, which is your property deductible amount, and then drawing out of that to live off another pot of money. It's really risky, and I've seen when it gets looked at by the ATO, generally speaking, it falls over because it's just not allowable. So I think what is allowable, and people need to understand, is you can minimize your tax by buying an investment which is negatively geared. So negative gearing, which is where the cost of the asset is more than the income that you make off the rental property, for example. And if you have that property in your own name, that deficit or the negative gearing amount reduces your tax. So that's a great way to do it. A lot of doctors around the country have a lot of property in their own names because of the fact they can do that negative gearing. But the whole debt recycling with property and a lot of the social media advertising around that is super risky. And again, you need to take the right advice, not from the property person, but from a tax person on that.
What makes it risky?
What makes it risky is the grey line between the strategy and the law. The strategy is dump your $250,000 a year that you earn into this tax deductible. Put all your money into the non-tax deductible and then draw money from the deductible amount. But you just can't do that, right? So they structure it behind the scenes to make it look right, but it's not right.
Hey, real quick, if you're a founder, CEO, or business owner looking to build a personal brand, become a thought leader in your space, and attract premium leads, our viral video podcast systems can help. Book a call with the link in the show notes to speak with my viral podcast team today. Now back to the episode. Company structures. This is something that was so overwhelming to understand when I was transitioning from sole trader to
We helped
company.
you with that. Yeah, I remember.
Absolutely. I did all of that with you guys.
Yep.
And what are the best company structures that help minimizing taxes?
Yeah. Okay. So the way you look at a company is a company is a separate legal entity, and it's not you. So it's a separate bucket. We talked about buckets before. I used to have a client that talked about structures as buckets, which was why I kept using it. But it's a separate entity that is not you. So you're Nelson, and Vibes Creative is your company, right? It's separate to you. Now, you may or may not own those shares, and again, you've got to take advice on how you structure that. But a company pays a corporate rate of tax. If it's an active business, it pays 25 cents in the dollar. So for all the listeners out there, if you're earning money in your own name, or you're a sole trader, and your tax bracket is more than 25%, and that's pretty easy to be at more than 25%, you have to seriously look at whether or not you should be running through a company or not. Because the great thing about a company is you get to fully deduct all the tax deductible expenses for the business, and at the end of it all, you only pay 25% tax. So it's a pretty cost-effective and tax minimization way to save money. And before we talked about super's only 15% tax. So a company where you get to use the money and do other things with it in the company structure is only 10% more than the super fund. So it's quite an attractive structure from that point of view. There are other sorts of structures as well. And generally speaking, a rule of thumb, because there's some rules that have changed, I won't get too technical, but there's other separate legal entities called trusts. A trust is generally a separate legal entity that runs for 80 years and is controlled by some people, some trustees. Pretty much every farm in Australia is owned in a trust because it's a great way to hand down assets. But trusts are good for investment and property. Companies are good for business and trading, is probably what I want people to take away from today. Trusts can own companies, but we won't get technical on that. But just keep that in mind. You don't want to be setting up a trust and then trading through a trust. There's some problems with that. But if you want to do what you did and move from a sole trader to a company, that would probably be a great bit of advice for the listeners out there.
Now, a common scenario as well is getting a company and a trust. And from my understanding, and even what we did for myself, is the trust, the company can be on your name, or the trust can own the company, and you happen to be a beneficiary from the trust, right? What would be the scenario that someone will be looking at in general?
Good question. If you knew you were growing a business and you sort of had a limited level on the height in which it's going to grow to, owning those shares in a company in your own name might be beneficial. The difference is, and if we use, your example, that the shares in your company are owned by a trust, because a trust is your family, it's not just you, and it's people related to you. So what that means is that if a company doesn't really have a ceiling and you know you're going to grow it, and it means that over time you can start to pay dividends out to the shareholders, and the shareholder is the trust, all of a sudden the potential $1 million in profits that you've earned over time can start to be legally distributed through the trust to your family members. And therein lies a lot of tax advantage with other family members within your family group. You've got to move the money to them and all that sort of stuff, but it's very tax effective. So maybe a real life example is if you're a physio and you're working as a contractor and you know that you're only ever going to earn $500,000 maximum, you're going to have $300,000 worth of costs. You might run it through a company, but you're going to own the shares in your own name. But if you're a producer and you know that your production company, you're going to turn over tens of millions, you're going to grow it sky high, well, then you need to own the shares in your company in a trust, in a family trust, because your family get the benefit of that. And if something happens to you, your family own the business through that trust as well, which is another positive.
And on top of being tax efficient, you also get the benefit of asset protection, right?
Absolutely. And asset protection, which means no one can touch the assets in the trust because it's a separate legal entity. It's not Nelson, it's not Justin. And you get to hand down the assets to family members. Like I have an asset in a trust that I want my kids to have. The whole idea is I want them to have a lifestyle with that asset, and when I'm not here anymore, then they can control it and have it. So sometimes it's more than just tax. It's thinking about that, the flow on.
Got it. And as an example as well, to tie it up with some of the things that we have spoken about, if you were to buy, let's say, some either assets or even some of the luxury items or collectibles, if the company is owned by the trust, do you buy those things under the company because basically the company is using these things for business, or are you buying those things under the trust because regardless the trust owns the company? I think there's a little bit of misconception of how things will
work. Sometimes it comes back to where the money is too. Like, depending upon if your trust is new or your company's relatively new, you haven't paid a lot of tax, so you haven't paid a lot of cash out to the shareholder who is the trust. You might be buying the collectibles. And remember, you can buy a watch as an investment and trade it and sell it. There's no law saying you can't. You just, you can't, as I was saying before, you can't be wearing it out every weekend if you're buying it in the company to use for personal use, because it triggers that fringe benefits thing we're talking about. So I think it comes back to where the money sits as to where you would buy that asset. And also if you think there's going to be a big gain on something, sometimes it might be like, for example, like watches, collectible cars, those sorts of things. There's been a lot of gains in those sorts of areas over time. And all of a sudden, investment managers are paying attention because they're going, oh, hold on, how come that Ferrari used to be worth $1 million, now it's worth $2.5 million? So a trust is a great way of owning that asset, because I talked before about the gain. So the capital gain on the sale of that asset, you can then distribute to potentially to other beneficiaries of that trust. So large items probably in trust, smaller items maybe in a company if they're going to be locked away and kept not for personal use.
And just to confirm, is for any reason the company gets in, or even the director gets in trouble legally, if the assets are under the trust, basically that is not a risk with the company or the person?
Yeah, so yes, separate entity as we were saying. So yeah, if something happens to the company, but the company's owned by the trust, any assets in the trust, they can't be accessed, but any assets of the company. So if you've bought something collectible in the company, it's an asset of the company, and for whatever reason you bring someone in to wind it up for you, well then they're going to go, well, I'm going to sell that asset and take the money and use it to wind down the business and pay creditors and things like that. So again, I think these examples are fantastic, but each specific one, people should be thinking about, okay, what's the ultimate aim here? Am I going to make a lot of money out of trading this asset? Which structure then is better for it to be in?
And this leads to an important question as well. If you buy your assets, and let's just assume that those assets are bought on the name of the company, can the company simply transfer those assets to either the trust or the individual?
Good question. So we can't just transfer the assets. The company needs to essentially sell them at market value. So you might have put money into a company to start it up. Someone might have put $100,000 in, and there might be an asset worth $50,000 in the company. If the company owes you money, you can transfer the asset out legally. But if the company doesn't owe you money, then you've got to pay for the asset if you're taking the asset. It's not yours, remember? It's the company's asset. So you can transfer them out. In all states around Australia, to transfer vehicles, you've got to pay transfer duties. Obviously, properties, you generally wouldn't own a property in a company. A collectible, again, you've got to do that properly, have valuation of what it's worth. So if it just happens to be a Rolex, you'd need to give it a value to make sure that if it was worth 40 and you're selling it for 20, there's a reason why it actually has dropped in value. You can't just do that for the sake of it. Because I think one good point, we talked about saving tax, but the ATO, because all our governments around Australia, and the ATO is just being, they've made it public, they're being more aggressive on looking at these sorts of things. So again, structuring it right, getting the right advice is really important.
Now, we talk about how to pay less taxes, but what are the most tax efficient ways of drawing money out of a company?
Yeah. So if your company is potentially owned by your trust and you have more than one of you might have a partner or potentially some dependents, so some kids, paying dividends out of the company, which is dividends to shareholders, so after tax profits, is a really effective way of taking money from a company. Again, it depends on each situation, and it depends on everyone's unique ownership structure. But generally speaking, that's a great way to get money out of a company. And also, too, we were talking about before, like if there are business assets that need to be purchased, and it doesn't need to be owned personally, well, it can be owned by a company if it needs to be used in that company. So that's a great way to be purchasing assets. But taking money out of the company, generally speaking, dividends. What's important actually just around paying less tax is you've grown up a little, you've set up a company, but you're sort of doing it yourself. You need to take advice not once a year, but a few times a year around tax planning as well. So this time of year, March, April, leading into June 2025, you'd want to be looking at, and you and I will be having a meeting in about a month's time. Where are we at the moment? What does it look like it's going to be at the end of June, 30 June 2025? And what can we do between now and then? Not necessarily superannuation, but it could be other assets. It could be the way that we're structuring something with our clients. What can we do to minimize tax? Because there are, some good strategies. I'm not going to share all of them today because a bit of it's some IP. But you need to be on the full front foot and planning ahead, as opposed to looking at tax as reactionary, like, what happened last year. You need to be a bit more on the front foot and proactive.
What are the most overlooked tax deductions that business owners make as well? Yeah, so
business-related travel and the ability to link your travel related to business. Sometimes people go, it's just easier to, that's personal or whatever. So looking at that element, and also to work-related assets and technology, all those sorts of things you should be running through your business. As I was saying before, the fun stuff, they've closed a lot of the loopholes. And again, we don't want excessive personal use assets in a company because it triggers this fringe benefits tax, which we don't want small businesses to be paying if they can avoid that. But generally speaking, it's those travel items. Also to training, sometimes like, all of the industries of all around the country, your industry, my industry, there's a whole lot of training. So I've actually got a conference on Friday this week. So we've got 2 days of training. Well, again, the cost of the training is a business-related cost, because without me doing that training, I can't improve. So training's probably another good one as well. And looking outside the box a little bit with training, because it doesn't have to be training in your specific industry. You can look to, it's got a link to how you earn income, but there's nothing stopping me doing a time management course. It's not tax related, but it's time management, or it could be some other business course, but that's still tax deductible. So again, looking at that and looking outside the square a little bit.
What's the craziest tax deduction request you have ever gotten from a business?
Well, I'm just going to tell you a little funny story first, that I was like in my 20s and sitting with a new client. His first name was Ken. I still remember this. And right at the end of the meeting, because he's like, I need you to fix my taxes for me and all that. And he said, there's one more thing I need to tell you. And we were like, yeah. And it was my boss at the time. He goes, I haven't done and lodged my tax for 15 years. So this guy had come to us, and we're talking about this new consulting business he had or whatever, and he hadn't done his tax for 15 years. So we had to make the call and fix that up for him. It was a big job to do that. But some people think they can get away with not doing it, but the ATO are cracking down on that you've got to stay up to date with your lodgements. So there's a bit of advice, actually. You're better off lodging and staying up to date with lodgements and then coming to an arrangement with the ATO to pay your tax if you've had a big tax bill than not lodging your return. The ATO hates people who are not compliant. Craziest? Some excessive travel, like, Greek islands travel through the business that we've just had to say, hey, Mykonos, yeah, you're trying to tell me it was work-related, but Mykonos,
a Caribbean cruise.
Yeah, Super Paradise Beach, the bar tab, no, yeah. And alcohol's one too. You've got to be very careful with, vintage Moet and Dom Perignon and stuff like that.
That leads perfectly then into what will a business do that will raise red flags to the ATO?
A lot of service industries, architects, hairdressers, engineers, there's a lot of benchmarking around for that. So your tax accountant can actually do some research and look at how you fit in a benchmark of producers, for example, as far as your... so the ATO likes to look at not just net margin, but gross margin. So the difference between your sales and your cost to produce that sale. So not necessarily the overheads and your rent, but it could be just your production costs, for example. So I think looking at that and I think not being greedy too. I think, as I said before, Australia has a system called self-assessment, which means you've got to be honest and lodge what you believe is correct. So the ATO now sometimes send letters out. They still send letters in the mail. It's crazy. I think it's because the government's still on part of Australia Post, half or full. I don't know, I can't remember. Something to do with that. They send letters out saying, have you been, do you want to reassess what you've put through your tax return? Because they do look at your income, if your personal income, and the level of deductions. So it's got to have this nexus or link between earning income, whatever you claim. So don't be greedy, but look at all the opportunities that you have, and if it's legitimate, of course you can claim it. And then the ATO sometimes there's different levels of review. They'll review it and then say it's okay, or sometimes they'll review it and want more information. Just depends.
What are the most common misconceptions when it comes with loans between a CEO and their company?
Yeah, okay. So loans that's a whole other podcast. Maybe we're not going to bore everyone for a whole podcast on it. But what's important is that analogy I used before, which is your company is not you. You may own it personally, or your trust may own it, but the relationship between the director or the CEO is there's an official, almost like employee-employer relationship. So if you take 10 grand from your company, and that's on top of your wage, the law basically says you've got to pay it back at a point in time. Some of you out there might have heard this thing called Division 7A, which you can pay it back over 7 years. But generally speaking, you need a strategy in which if you do need, just to say you've come off a fixed rate mortgage, your mortgage payments have gone up, so you need more money. So there's nothing that says you can't take the money from the business. But the law now says about these loans, you do have to pay it back over time. So you can pay it back by putting the money back in, You might pay it back by declaring a dividend but not taking all that cash. So declaring a $50,000 dividend but only taking 20 grand extra and leaving the 30 in the company to pay back your loan. So it's just about structuring your loans properly, and again having agreements in place, because this Division 7 I talked about is a so basically every business owner around Australia in their company has in and out on their loan account. So it's a matter of managing that and making sure that you're not too aggressive and pulling too much out without having that right agreement in place to pay it back.
And question that came to mind as well with some of those tax deductions that can be done, as an example, training. To give you a very real example, I have a mentor that is overseas, so I'm paying that in USD. How does that work in terms of, I'm guessing obviously that's fully tax deductible, but as an example, there's no GST, for example, in that.
Yeah, but it's a deductible cost. Let's just say you've paid for that yourself. But the company, if you'll have to have a receipt of payment in the USD, no GST implication, but the company can reimburse you for that cost. Just because it's overseas, as long as it's business related, that connection or nexus between earning the income, without that mentor, you wouldn't be growing your business the way you are. So if you pay for it personally, the company can then pay you back, or the company can pay that directly as long as it has an invoice. And then if there's no GST, obviously you can't claim any GST on that, but it's a tax deduction. So training doesn't have to be in Australia. It just has to be related to what you're doing. And remembering, training out there can be, if you're doing some investing, it can be investment training. It can be, mentoring. And I've done the same with coaches and stuff like that. So,
got it. In terms of exiting a business, something that I've come to basically the conclusion through mentorship and my own learnings is that it's always a good idea to be planning for a possible exit of your business, or having a business that is sellable that ultimately makes it more of an asset, right? Yep. In terms of selling your business, what are things that a business owner should keep in mind when it comes to the tax implications of exiting a business?
Yeah. So firstly, before tax, a couple of people I know, like the best entrepreneurs have this window in their head and they go, I'm just going to do this in 5 years. I'm going to build it and I'm going to sell it. I'm a bit sentimental, and maybe because I'm an accountant by trade, I'm like, I like my business. I'm going to keep doing this for a really, really long time. But I think what's really important is that when you start your business, you should have the exit in mind. And then I heard a really well-known businessman speak face-to-face once. It was like a breakfast roundtable thing. It was a guy, the surname's well-known in Australia, called Richard Pratt. I heard him speak once, and he said from when you start your business to when you get it absolutely humming to, potentially that sale, sometimes it's probably up to 7 years. So sometimes you think you're going to do it in 2, but it might take you 5 or 7 years. But if you don't start with the exit in mind, you won't structure it properly, number one. And then you might be doing yourself a disservice, because I mentioned before, you could be doing yourself out of hundreds of thousands of dollars in tax. So the right structure in the beginning means that you can potentially avail yourself of some tax concessions, some capital gains tax concessions when you sell. So doing that's really important. But again, the clients that we've advised on and the people I've seen do it best, and the entrepreneurs that I've seen it do it best with multiple businesses, a little bit like we were talking about before, get the structure right, put the systems and people around, start reporting. If you want to sell in 2 years, start reporting now and make sure your books are super clean, because the graph has got to look like this every year. It's got to go up every year. And to do that, you can't be too grey with what you're claiming or whatever. Like, treat it almost as if you're going to have a public company buy your business. Treat it super clean, because if you know that you want to get out in 2 or 3 years, you got to have those numbers looking like very clean. Because when they do what's called due diligence on the business, they want to make sure that there's things in there that aren't going to raise red flags. So putting the process in place and getting your numbers right for a number of years, so you got that consistency on ready for sale. Like we did one last year to a French company, so French multinational company. We help advise on transactions, and sort of I call it sort of business handholding along the way. Obviously, there's tax as well, but we made sure that for the few years before that, numbers were really clean. So we were able to give a data table to the buyer and go, here you go. Here's the gross margin. Here's the EBIT, earnings before interest and tax, every year. Here's the average of the EBIT over 3 years, and this is what the multiples should be, and this is why we want X million for the business. So if people can take that away, I think that's important. Think now what it's going to look like when you sell it and get ready for that.
Am I correct in saying that then that summarizes to be okay with paying a lot of taxes leading towards the sale, because essentially you want to, on paper as well, show that the business makes lots of profit?
Yeah, so be okay with paying the right amount of tax leading up to a sale, because it will show that you've got good cash flow, you've been paying the tax. So yes, but I said before as well that a misconception about company tax, that 25% I was talking about before. So when you pay individual tax, once it's paid, it's gone. With a company, when you pay tax, it's a strange concept, but the credit for the tax goes into the company's, it's called a franking account. And when the company pays a dividend, say to a family trust, it has this little credit of 25% tax that's attached to it. So don't be scared about paying company tax, but have someone explain it to you that how you can use that company tax to pay dividends out to your family in the future. And also when you're going to be selling the business, then you've got the right amount of tax paid along the way to show that the business has been making some really good money.
Got it. In these two scenarios that we've been covering along the conversation, founder owns his company directly on his name, and then we have a company that is being owned by a trust. If those businesses get sold, what are the different tax implications on both scenarios?
Yep. So depending upon the family structure behind the trust ownership, that has something to do with it. There's a threshold in Australia for small business concessions when you sell a business. If your business is worth less than 6 million and you sell, your net asset amount around that is less than 6 million, you both personally and in the trust, you get an extra amount of concession or reduction in tax. So maybe if we talk about if it's over 6 million, there could be, I said before, hundreds of thousands, but there could be potentially a lot more savings by being owned through a trust, because you get to distribute the gain amongst a number of different entities and or people. If it's less than 6 million, when you make a capital gain in Australia, you pay tax on that gain, but you get as an individual what's called a general discount on selling a business. So you only pay tax on half of the gain. So owning the business in your own name, owning the shares in your own name, may or may not be punitive for tax reasons. But I think what's important is the structure of how you own those shares is really important. And when you sell the business, this is why you got to have the right advice along the way. If I was to sell my business, if I sell the business as opposed to selling the shares in the company, it's a different thing. So we used an electrical contractor before. He sells his clients and his electrical business out of the company pays tax. But if he sells his shares, there could potentially be other capital gains tax concessions and bonuses that you can reductions of tax that you can get in the future. So that's probably a really good takeaway that most people don't know, and that's what we advise on when you're initially talking to a potential third party that's going to be buying your business. One of the initial discussions after you've given them some information and signed the NDA, so there's no disclosure of information, is, am I selling my business or am I selling the shares in my company?
Interesting.
Yeah.
I've
That's a
never
whole other
heard
world.
of
That
that.
one. Yeah. It's a real, because that can mean the difference between the money being stuck in the company and it costing you a whole lot of money to get it out versus the money going into your trust and you having full access to it. It can, and it's sometimes a really big difference in tax payable as well.
So just to confirm, if you were selling your business and you sell the shares of it, that means that all that money comes
to your trust. And so generally speaking, a general piece of tax advice: selling shares in a company will be more beneficial than selling the business out of the company, because the money gets stuck in the company. So I can think of 9 times out of 10 where that's definitely the case.
Got it. What's the role of a great accountant when it comes to a business exit?
Yeah, so I'll be honest. A lot of sort of suburban accountants or smaller accountants may not have the experience when it comes to the transactions relating to business. So, for example, I used the example before. We've sold to Australian public, helped clients and advise on selling to Australian public companies, international globals. I think it's about having the right advisor for your business to hold your hand in the process. So initially, we've got one at the moment. We've provided some information. We've said, make sure an NDA is signed. It's an Australian company selling to an Australian company. And then once they start talking about dollars, you're engaging us, because the dollars, the structure, the earnout, there's a whole other discussion around the earnout. No one gives you $10 million and just says goodbye. They say, hey, we want you, Nelson, to stay for 3 years. So having the right advisor, and if you love your accountant and they're doing a great job on your general tax, there's nothing saying that you can't have another advisor like myself, and there's a lot of people out there, to help you advise on the sale and advise on the actual transaction. So it's not just the tax piece, but it's the structure of the transaction, the earnouts, tax,
Got it.
performance, all that stuff.
Before I ask you the last questions, this is a segment called Rapid Fire, and it's pretty much this or that.
Yep.
Okay. So you literally just choose this
Yep.
or that. Tea or coffee?
Coffee.
Sushi or steak?
Definitely sushi.
Expert or jack of all trades?
Jack of all trades.
Product or service business?
Service.
CEO or founder?
Founder.
Founder or managing director?
Founder.
Instagram or TikTok?
Insta.
Instagram or YouTube?
Insta.
Instagram or LinkedIn?
LinkedIn.
LinkedIn or X?
LinkedIn.
Photos or videos?
Video.
Short form or long form video content?
Short form.
Newsletters or podcasting?
Podcasts.
Organic or paid marketing?
I've learned a lot about this organic.
1 million followers with low conversions or 1,000 followers with huge ROI?
Million. Low conversion.
Building a talent or hiring a talent?
Building the talent.
A talent at a high price tag or multiple cheap C talent?
High talent, high price tag.
Property investing or shares?
Property.
Property or crypto?
Property.
Property or Bitcoin?
Property.
Property or buying businesses?
I'm a WOG. Property.
Building a business or buying a business?
Building.
Passion 6-figure business or stressful 8-figure business?
Passion 6-figure.
Most important question of all, sales or marketing?
Marketing.
And bonus one, depreciating a G-Wagon or a Rolex?
G-Wagon.
What are the 3 things that you will tell your 30-year-old self about building a successful 8-figure business?
Trust no one. I was a bit too trusting when I was 30. So yeah. And if you do have an inner sanctum, make sure you trust those people and they're really close to you, and stay private, but be very careful about trusting people on face value, because once you become successful, people try and take advantage of you, unfortunately. That's what I've learned in life.
Got it. That resonates with me because I come from a third world country.
Yeah.
What's the worst piece of business advice you have ever received?
I think, with all due respect to my legal mates, lawyers are... So be careful about working with lawyers and the scope of working with lawyers. So unfortunately, if you do have to go down the path, and I've had to sue people before, how long is a piece of string? A legal case, I bought a business off a guy many years ago he was a crook, and I had to sue him, and the legal thing went on for, hundreds of thousands of dollars. So just be really careful with lawyers, whether they're advising on a business sale, whether they're advising on a new lease. Get the quote and get the scope. So that's probably, so it's not bad advice, but it's more around working with lawyers and those type of advisors, you need to know exactly what you're going to be paying.
That is really good piece of information. We're definitely saving that story for the second round.
Second round.
And lastly, what's the best piece of business advice you have ever received?
As your business grows, having the right people, it's not just advisors and accountants, but potentially you might even have a board of advice. So, many years ago, our business was actually a lot bigger than it is today, and I had a board of advice. So having mentors and key people, not necessarily always from your industry, but from complementary or disruptive industries, on a board of advice with you that might meet every month or every quarter as your business grows, especially when you get to a certain size, is something that I've learned to do, and it's paid dividends.
Justin, this has been an absolute banger of conversation. Myself got so much value, and I'm pretty sure all the business owners out there are probably even having some breakthroughs when it comes to tax and strategies and paying less of it or the right amount of it. Where can people find you, engage your services, or even connect with you and ask you more questions or see where that goes?
Yeah, sure. So obviously on LinkedIn, our business is called Rees Group, REES Group. So we're online and you can find us there. Justin Mastores is my name. I'm on Insta as well, Wine, Whiskey, Water, if you want to, I'm a bit of a passionate wine man. So if you want to DM me on Insta, that'd be good too. But feel free to reach out, jump on our website, send me a query. I'd love to talk to people. So
if you enjoyed this episode, I would love for you to drop some comments on additional questions that you might have, because Justin, since he bought a new business up here, he's going to be coming more often. So there's probably a really good chance that we're going to be doing a second round so we can answer those questions. Share it with any other founders, business owners that might benefit as well from this conversation. And all the links are down below. I look forward to seeing you on the next episode. Good vibes for everyone. Hey legends, my goal with Founders Playbook is to help 1 million entrepreneurs build successful personal brands and businesses so that they can increase their impact and profits. You can support the mission by simply sharing the podcast with other founders and entrepreneurs. Leave a 5-star review on Apple Podcasts and Spotify, and follow us on social media. Let's get to work.